Most people think a market crash is the worst thing that can happen to their money. It's not. If you set things up the right way, a crash is actually the moment your money grows the fastest. Today, here's the data behind the exact compounding setup that turns a market crash into a payday. Three simple things that, historically, separate the people who came out ahead from everyone else. Quick reality check before we go further. We are not in a crash right now. As of this month, the S&P 500 is up about 13% this year and sitting near record highs. But there are real warning signs. The Nasdaq has already had two corrections in 2026 because of a sell-off in chip and memory stocks. Analysts are watching a possible interest rate move in September, ongoing inflation pressure, and, historically, U.S. midterm election years tend to bring rough stretches for stocks in the second half of the year. None of that means a crash is guaranteed. It means the odds of one are higher than normal right now, which is exactly why the data below matters now, not later. Here's the one idea you need to understand before anything else. Growing money and losing money are not equal and opposite. Say you put in $10,000. It grows 10% one year, then 10% again the next. Now you have $12,100. Then the market drops 40%. You might think you're back around where you started. You're not. You're at $7,260. And to get back to that $12,100, you don't need a 40% gain to undo it. You need a 67% gain. A loss always takes a bigger win to fix than the loss itself. This is why the data consistently shows the same pattern. People who sell in a panic during a crash often never fully recover. They lock in the small number, then miss the climb back up. Stick with me till the end. Here's what actually separates the people who come out ahead. First, some context. There are three sizes of market drop. A correction is a fall of 10% or more. These happen often, roughly every year or so. A bear market is a fall of 20% or more. These happen every 4 to 5 years and last about 10 months on average, compared to the good stretches, called bull markets, which tend to run about 3 times as long. A full crash is a drop of 30% or more, and while it's rarer, it does happen. 2008 and the COVID crash in March 2020 are recent examples. If you invest for long enough, the data says you will go through all three at some point. That's not a scare tactic, it's just how markets work. So here's what the data shows the prepared investor typically has in place. 1. A real cash cushion. The pattern that shows up again and again is 3 to 6 months of normal living expenses kept in a high-yield savings account separate from investments. Why does this matter so much? Because when the market drops, people often also hit real-life costs at the same time. Losing a job, a medical bill, a car repair. Without cash set aside, the data shows people get forced to sell investments at the worst possible time just to cover a bill. That's not bad luck, that's a missing safety net. 2. Investing that runs on autopilot. This is called dollar cost averaging. A simple idea where you invest the same amount of money on the same schedule every time, no matter what the market is doing. Here's what the numbers show it does in a crash. Say you invest $200 a month. In month 1, shares cost $20 each, so you get 10 shares. The market drops. In month 2, shares are $10 each, so that same $200 now buys 20 shares. In month 3, prices climb back to $15, so you get about 13 shares. After 3 months, you've put in $600 and ended up with 43 shares at an average price of under $14 each. More shares than you'd have gotten if prices had just stayed flat the whole time. The data shows the crash didn't hurt that outcome. It produced a discount. And the pattern only holds when it's automated, set up so it happens on its own. Because the data also shows that when accounts turn red and headlines say catastrophe, most people's instinct is to stop. Historically, that's the exact moment the numbers reward continuing. 3. Money spread out before the drop, not after. The data on this is consistent. Not putting everything into one company or one type of stock, but splitting it across a mix. Broad US stocks, some international stocks, a little bit in bonds for stability. When one part drops, the pattern that works is rebalancing, selling a small amount of what's still doing well and using it to buy more of what dropped. That's the opposite of what most people do naturally, and the numbers show it pays off over time. In 2008, financial sector stocks were hit even harder than the broader market. In the dot-com crash, tech stocks fell nearly 80%. The data on people who were concentrated in just one of those areas is stark. Many didn't just lose money, they lost years, even decades of progress they'd already built. Here's the part the data says matters more than strategy: your brain. Researchers Daniel Kahneman and Amos Tversky found that losing money feels roughly twice as bad as gaining the same amount feels good. That's not a personal weakness, it's just how humans are wired. But the numbers show it's dangerous for investing because it pushes people to sell at exactly the wrong moment. Look at what actually happened. Between late 2007 and early 2009, the market fell about 57%. A $100 account dropped to around $43,000. Genuinely scary. But the data on anyone who kept investing $500 a month through that entire stretch shows they ended up buying shares that were worth several times more a few years later. Same story with COVID. The market fell 34% in about 5 weeks in March 2020. One of the fastest drops ever. And the data shows it had fully recovered by that August, about 5 months later. And here's the detail the numbers make clear. Looking at the last 20 years, 7 of the 10 best trading days happened while the market was in bear market territory. Sell during the scary part, and the data shows you don't just lock in a loss. You very likely miss the exact days that would have paid you back the most. The data doesn't show that the people who end up richer after a crash are smarter or luckier. It shows they had 3 things already in place: cash set aside, automatic investing that didn't stop, and money spread across more than one basket. By the time a crash shows up on the news, the numbers say the outcome for those people was already decided, weeks or months earlier, while everything was calm. I'm not telling you what to do with your money. I'm just showing you what the numbers say, so you can make decisions based on facts instead of fear. If this helped, hit subscribe and tell me in the comments, would you keep investing during a major crash? Just a reminder, this is educational content, not financial, investment, legal, or tax advice. Any results depend on your own decisions and actions.